This is Franz. Welcome back to the Series 7 video episodes. This is going to be episode number 8, and in this video episode we're going to be talking about money market instruments. Now I'm going to deviate a little bit, and this is probably going to be the pattern from the video episodes from here on out, where I'm going to bring in some web resources that you can look at to further enhance your knowledge of the different topics that you need to understand for the Series 7 examination. Now, a lot of this additional information is going to give you much, much more than you need, but I'm a big believer that all knowledge is good knowledge. And if you have the time and the inclination and the interest in getting additional information, then I do encourage you to use some of the resources we're going to point out that are, for the most part, publicly available resources. I was able to find these by doing Google searches on the internet for the most part. So let's first of all get right into it. So what are money market instruments? Money market instruments are debt obligations that mature in 1 year or less. What does this mean? Well, it could be a long-term bond. For instance, a 10-year bond, a 5-year note, or a 30-year Treasury bond, but if it matures in 1 year or less, it's considered a money market instrument. Institutions such as banks and large corporations that have cash that need to invest or borrow will invest or actively participate in the money market instrument market. Usually you need to be trading about $1 million or more to participate in this market. Now, almost all money market instruments trade at a discount to par, but in the case of short-term but in the case of bonds that mature in less than a year, they would trade with accrued interest. But Treasury bills, commercial paper, those type of money market instruments trade at a discount to par. So you buy at a discount and they mature at par. So let's look at what the types of market debt or money market instruments we're talking about are. Treasury bills are probably by far the largest category of money market instruments. These are what are typically bought in money market funds. And in fact, if you ever look at the prospectus on a mutual fund, a money market mutual fund, you will see that the vast majority of the holdings in money market accounts, money market mutual funds, will be made up of treasury bills. Here's some resources that you can go to and learn a little bit more about this. So here's the Resource Center, and this is from the U.S. Department of Treasury, and this is giving you the daily Treasury bill rates. And the day we're looking at this is August 20th, 2013. And what we see are rates, 4-week bank discount rates of 0.02%, 13 weeks at 0.04%, 26 weeks at 0.08%, and 52 weeks at 0.12%. Pretty darn low rates. You can play with this and you can look at different things. Here's a historic yield curve. And I had to load the Flash player for this to work, and it doesn't seem to be coming up. Now, since I'm using a software program to record this video, apparently it's disabling the other Flash, Adobe Flash, which brings up this yield curve. So you're just going to have to trust me if you play with this that you need to have Flash installed. But you could view the text version of the yield curve, which would basically graph this out to you, the yield curve from 1 month out to 30 years in a yield curve. Bankers' acceptances are another type of money market instrument. And here's something I wanted to show you on the history of T-bill rates.